Hello, everybody. We're Team 6, and today we're going to talk about the second group case, Montaditos franchise. And here's our agenda. The introduction, a little bit about what this case is about, and we have some sheets and tables like income statement, balance sheet, cash management, free cash flow to firm. Then we're gonna move forward to the financial metrics that we have calculated, and we're gonna give our conclusions about this case. So about Montaditos, our founders would be our alumni Zara, Coco, and Gautier. The business mode would be they're gonna franchise from a Catalan chef, and the initial investment would be 200,000 euros. The location would be in front of the Barceloneta beach near the W Hotel. So the purpose of this case is we have to convince our investors from SADE Bank to finance this project. And what we're gonna do is we're gonna ask for more help from Sarah's classmates, meeting Samir, Dominic, and Nick at 9 p.m. in W Hotel lobby to discuss the feasibility of this project. So we're gonna calculate the minimum, the NPV, IRR, and payback period, and some other related data. Samantha's next.
So first, let's take a look at the income statement, which will show the company's income and expenses over the next 4 years. We forecast that the sales for the first year will be around 500,000 euros, and we are convinced that it could increase by 3% per annum over the next 3 years. Also, we calculated the cost of the raw materials to be around 30% of the sales. Therefore, after some calculation, we can see that the annual EBIT will always be more than 80,000 euros, which means that the business is going to be very profitable. Next, moving on to the balance sheet. For this business, the amount of account receivable will be zero since the clients will all be paying in cash. Now, if we take a close look at the return earnings, we can see that the amount of return earnings is the same as the EBIT in the income statement. This also means that the business will be generating a lot of profit, and the profit can be used for making further reinvestment or for giving out dividends to shareholders. Third, in terms of the cash management, we calculated sales as inflows and other expenses as outflows. We assume that every year there will be around 50,000 euros of new non-current assets payments, but no increase in operating cash at all. Finally, we managed to calculate the final amount, which appears to be the same with the final amount of free cash flow to the firm over the next 4 years, proving that our calculation is correct.
All right, so now we're going to move on to the free cash flow to the firm. So the first element we can see is that in year 0, we have our initial investment of 200,000, which explains the negative free cash flow to the firm. Then we have for year 1 onwards positive cash flows, which is a good indication. And then for year 5, we can also see the perpetuity that we have calculated by using the cash flow to the firm of year 4 and dividing it by the discount rate of 15%. Lastly, we have the accumulated free cash flow to the firm that enables us to see that the payback period would be in year 4. Now, moving on to the financial metrics, we have ROA and ROS, which we have calculated. So the ROA we found was 43.57%. We did see that 5-year top 15 restaurants have had an average of 8.97% for an ROA. So we do think that 43% seems quite big. Now, either this investment is very, very good, or the numbers have been quite optimistic so far. Then we have the payback period, as we said, that would be 4 years, and we have the net present value of the investment, which would be 259,157. So being a positive NPV, meaning that the company is creating value, which is a good indicator for an investment to be positive and a good investment to make. Now, we have an IRR of 42.6%. However, we will be looking more at the modified IRR, which we found to be at 35.80%. This is quite a high IRR. Of course, indicating again that this investment could be very profitable. Now, lastly, we're going to go to the conclusion. So in terms of conclusion, we do want to mention that we have looked up some industry averages for payback period, which stated that it would be around 2.5 years. However, of course, our investment still seems quite profitable, and 4 years do seem in the scope of this project. So this wouldn't be a problem in our opinion. Then also, of course, we have found a positive NPV, as well as the discount rate being 50% is lower than our modified RRR of 35.80%. So this seems really to be a good investment and not an opportunity to overlook. But we do have to mention finally that the MIRR as forecasted is still lacking of accuracy, especially since all of our sales and cost forecasts, I mean, they are a forecast, so we cannot be 100% sure this is either a best case scenario or not. Later in the future, what we could do is calculate different forecasted sales and costs and see how the NPV and the IRR, change depending on our optimistic or pessimistic approaches. Thank you so much for listening, and if you have any questions, please reach out to us. Thank you.